was the subject which we have discussed so far, right? Cost is an expenditure. Costing is the technique or the process of ascertaining cost. Cost accounting is the process of recording, classifying, analyzing, allocating, reallocating, and apportioning every unit of cost to every unit of product or service. Cost is a broader term which includes various elements into it. So, we have the direct cost, which is direct material, direct labor, and direct expenses. We have the overheads, which are the indirect expenses, which is classified into factory overheads, administration overheads, selling and distribution overheads. There is another classification of cost wherein it is variable cost, fixed cost, and semi-variable cost. Variable cost will change with change in volume of production. It will remain constant on a per unit basis. Fixed cost will change only on a per unit basis, whereas it will remain constant in total. Semi-variable cost is partly fixed and partly variable, which will behave according to its nature. Then, coming to elements of cost, we had detailed discussion of the material, labor, and overheads. Then, we moved into applicability of costing for various sectors, where we discussed job costing, batch costing, contract costing, process costing, joint product, byproduct, and operating costing. Then we moved into techniques of cost control, where we discussed standard costing, marginal costing, and budgetary control. Finally, we concluded with cost bookkeeping. Now coming into the elements of cost, materials chapter. In that materials chapter, it helped us to answer the following questions: what to buy, where to buy, when to buy, how to buy. Right? What to buy is the raw material. When to buy is the stock level. How much to buy is the ordering quantity. To which supplier to buy is based on the supplier discount which is offered, right? EOQ is the optimum ordering quantity, which is calculated as root of 2 AO by C, where A is the annual consumption of raw material, O is the ordering cost per order, C is the carrying cost per unit per annum. At EOQ, ordering cost is equal to carrying cost. The total ordering cost is number of orders into cost per order. Total carrying cost is Q by 2 into CCPUPA, right? When the supplier is offering a discount, carrying cost must be calculated only at the discounted purchase price. The total cost of raw material comprises of the purchase cost, ordering cost, and the carrying cost. That ordering quantity for which the total cost is minimum will be the optimum ordering quantity. If it is at EOQ, ordering cost will be equal to carrying cost. Then we moved into stock levels, wherein we had reorder level, maximum stock level, minimum stock level, average stock level, and danger level. Reorder level is maximum consumption into maximum reorder period. Maximum stock level is reorder level plus reorder quantity minus minimum consumption into minimum reorder period. Minimum stock level is reorder level minus normal consumption into normal reorder period. Average stock level is maximum stock level plus minimum stock level by 2. Or minimum stock level plus half of reorder quantity. Danger level is normal consumption into time required for emergency purchase or minimum consumption into time required for emergency purchase. Then we moved into the preparation of stores ledger, wherein we had FIFO, LIFO, simple average, weighted average, replacement price, standard cost method, and so on. FIFO, first in, first out. LIFO, last in, first out. Replacement price method, issues is at the replacement price. Standard cost method, issues will be at standard cost. At the end, you will calculate the variance. Then we had the simple average and weighted average method, where the issue price under weighted average method will be the value which is Q into A divided by Q. The weighted average price will be the issue price. In case of simple average method, we will have FIFO as a hidden basis to determine the issue price. If one particular stock is already issued and is out of stock, I will not take that price for issue under simple average method. So, simple average method as a hidden basis follows FIFO. Then we moved into classification of stock for the purpose of analysis and control, where we discussed ABC analysis, FSN analysis, and VEP analysis. ABC analysis classifies goods on the basis of value and weight. High in value, less in weight are A category items. Low in value, more in weight are C category items. B category items are moderate in value and weight. VED analysis is vital, essential, and desirable goods. FSN analysis is fast moving, slow moving, and non moving goods. How do you identify if one particular good is fast moving, slow moving, or non moving? Based on inventory turnover ratio. Inventory turnover ratio is cost of raw material consumed divided by average stock of raw materials. Cost of raw material consumed is opening stock plus purchases minus closing stock. Average stock of raw material is opening stock of raw material plus closing stock of raw materials divided by 2. This summed up materials chapter. Then we moved on to labor chapter. In labor, it was computation of wages. The wages paid to the laborer can be on the basis of time or on the basis of piece. If it is on the piece rate basis, it is number of pieces into the rate per piece, which is straight piece rate. In case of straight time rate, it is number of hours into rate per hour. Coming to differential piece rate plan, Taylor's differential piece rate plan and Merrick's differential piece rate plan. Taylor said less efficient, less than efficiency, give him only 80% piece rate. At or above standard, 120% of piece rate. Merrick said up to 83% efficiency, 100% piece rate. 83 to 100% efficiency, 110% of piece rate. Above 100% efficiency, 120% of piece rate. Then moving on to the time rate plan where we had Halsey and Rowan. Halsey plan is hours worked into rate per hour plus 50% of time saved into rate per hour. Rowan plan is hours worked into rate per hour plus time saved by time allowed into hours worked into rate per hour. Time saved is time allowed minus hours worked. If instead of Halsey plan they call Halsey Beer plan, it is hours worked into rate per hour plus 30% of time saved into rate per hour. Emerson's efficiency plan up to 66 to by 3% normal time rate, guaranteed time rate. 66 to by 3% to 100% efficiency. It is guaranteed time rate plus a percentage of bonus. That bonus will range from 1% to 20%, such that at 100% efficiency it is 20% bonus. Above 100% efficiency, the basic time rate plus 20% bonus plus 1% additional bonus for every 1% increase in efficiency. Then we discussed Gantt task and bonus plan, which is a combination of both the time rate and the piece rate plan. Below standard, guaranteed time rate. At standard, guaranteed time rate plus 20% bonus. Above standard, high piece rate. So Gantt task and bonus plan is a combination of both the time rate system and the piece rate system. Then we moved into labor turnover. Labor turnover is the calculation of the movement of labor force in an organization, where it is calculated by 4 methods: separations method, replacement method, flux method, and accessions method. Separations method, number of workers separated divided by average number of workers into 100. Replacement method, number of workers replaced by average number of workers into 100. Flux method, number of separations plus number of replacements divided by average number of workers into 100. Accessions, number of separations plus number of replacements plus number of new additions due to expansion divided by average number of workers into 100. Number of separations will include the number of workers left and discharged. Number of replacements will be the total recruitment, out of which how much ever is only taken for replacements, you will take only that number. Only in accessions method you will take the entire new recruits. Then we discussed on the effect of labor turnover. When it comes to effect of labor turnover, you will have to settle the exiting employee and you will have to incur cost for the new worker. So you will have settlement cost, recruitment cost, selection cost, training cost, and the sales lost during productive hours spent on training. That was the effect of labor turnover. With that, we concluded the labor chapter. Then we discussed the inclusions and exclusions in labor as per case 7, where we considered all the inclusions and exclusions as provided by the accounting standard, and we discussed a few sums on it. Then we moved into overheads chapter. Overheads is a list of all indirect expenses. So, what do you first do is prepare the primary distribution summary, where you allocate the all overheads incurred to all the departments in the organization, irrespective of production or service departments. So, you will allocate the expenditure to various departments on an equitable basis. Excuse me. Rent and rates on the basis of floor space, depreciation on the basis of asset value, ESI on the basis of direct wages, supervision on the basis of number of workers, power on the basis of horsepower of machine, excuse me. I have told you the basis for allocating certain expenses like rent on the basis of floor space, supervision on the basis of number of workers, ESI on the basis of direct wage, power on the basis of horsepower hours, and so on. Electricity or lighting on the basis of light points, and so on. The direct cost of service department must be taken at actuals. The direct material and direct wages of service department must be taken at actuals as part of primary distribution summary. The next step will be the secondary distribution summary, where the overheads of service department will be reallocated to production departments. There the services can be classified into reciprocal service and non-reciprocal service. Reciprocal service is a type where one service center will render service to the other and it will also take back service from the other. That is a case of reciprocal service. Non-reciprocal service is where one service center will render service to the other center, but it will not take back anything from them. That is non-reciprocal service. The various methods of allocating the service department cost to production departments can be direct distribution method, where they will directly give you the ratio. Given the ratio, you can allocate the cost in that ratio. Then, given the cost, you can directly allocate it in that ratio. Repeated distribution method. You will repeatedly distribute the overhead cost until it reaches zero. Simultaneous equation method. If there are two service departments, you will develop two equations for the total cost of the service department. Solve for x and y. Post it in the overhead distribution summary. Allocate the cost in the ratio given. You will arrive at cost of only the production departments. Then step ladder method, where it applies only in case of non-reciprocal service. You will allocate the maximum number of service first and then in the descending order. With that, overhead distribution summary is over in both terms of primary distribution and secondary distribution. Now coming to recovery of overheads. Recovery of overheads can be on the basis of 5 different methods. On the basis of material cost, on the basis of wage cost, on the basis of prime cost, on the basis of labor hours, on the basis of machine hours. If it is on the basis of material cost, overheads by material cost into 100, overheads by labor cost into 100, overheads by prime cost into 100, overheads by labor hours, overheads by machine hours. Blanket rate is one common rate which is applied for the entire organization. Instead, it would be better to apply the specific rate for every organization to arrive at a more accurate estimate of cost. Overheads are recovered at predetermined rates, which is an estimate. Later, when compared with actual overheads, you may end up in over-recovery or under-recovery of overheads. There are two ways of treatment of over-recovery and under-recovery of overheads. Either charge it to P&L account or calculate a supplementary rate. The calculation of supplementary rate applies only for under-recovery of overheads and not to over-recovery of overheads. If it is posted as a journal entry, costing P&L account data to overhead control for under-recovery, overhead control to costing P&L for over-recovery. When it is a supplementary rate, add up all the units, calculate the amount of under-recovered overheads. How do you find that? Observe actual overheads minus applied overheads will give you the under-recovery of overheads. That under-recovery of overheads will be divided by the total units to arrive at the supplementary rate per unit. Apply the supplementary rate to the volume of output at each level. You will arrive at the corrected value of the goods. That is by calculation of supplementary rate, where you treat the under-recovery of overheads. You do not have supplementary rate when it comes to over-recovery. Then, if the absorption of overheads is due to defective planning, you always have to charge it to costing P&L. You cannot find a supplementary rate if it is due to abnormal reasons of defective planning. With that, we calculated the machine hour rate, where we added all costs related to operation of the machine divided by the machine hours. You will get the machine hour rate. If you are including operators' wages as part of the statement, the result arrived is called as comprehensive machine hour rate. If operators' wages is not included, it is simple machine hour rate. Setup time, productive time, and then the maintenance time. Maintenance time is always unproductive. Setup time can sometimes be productive, sometimes be unproductive. So depending on the information provided in the question, you will take the hours accordingly. With that, we concluded the elements of cost. Then we moved into applicability of costing to various sectors, where we started with job costing. Job costing is nothing but preparation of a cost sheet. You will add all the costs related to the job, then add the profit margin and submit the quotation for the order. Right? So it is direct material, direct wages, direct expenses, prime cost plus factory overheads, works cost plus administration overheads, cost of production plus selling overheads, cost of sales plus profit sales. This finishes the job costing. Then it is batch costing, where the goods are produced in multiple batches. EBQ is the economic batch quantity, which is calculated as root of 2AB by C, where A is the annual demand of finished goods, B is the batch processing cost, C is the carrying cost. It is very similar to EOQ. EOQ is for raw materials, EBQ is for finished goods. At EOQ, ordering cost is equal to carrying cost. At EBQ, batch processing cost is equal to carrying cost. That will give you the total production cost to be the least at EBQ. Okay. At EOQ, it is for raw materials. At EBQ, it is for finished goods. With that, batch costing was over. Then we moved into contract costing, where construction sector takes up this method of costing. You open the contract account, debit all expenses incurred for the contract. If there is a plant which is used, you will have to take depreciation on the plant. To the credit side, you have WIP, which is work certified and work uncertified. If the contract is complete, you will credit the contractee account on, you will post by contractee account on the credit side and close the contract account. As long as there is WIP, the profit booked in contract account is called as notional profit. The portion of profit transferred to P&L is based on degree of completion of contract, which is measured as work certified by contract price. If degree of completion is less than 25%, no profit is transferred to P&L. If the degree of completion is between 25 to 50%, one third of notional profit into cash received by work certified will be transferred to P&L. If degree of completion is between 50% to 90%, two-thirds of notional profit into cash received by work certified will be transferred to P&L. If degree of completion is beyond 90% and is nearing completion, it will be the estimated profit and a portion of it which will be transferred to P&L. Estimated profit is contract price minus estimated total cost. The profit which is transferred to P&L will be estimated profit into work certified by contract price, estimated profit into work certified by contract price into cash received by work certified, estimated profit into cost till date divided by estimated total cost, or estimated profit into cost till date divided by estimated total cost into cash received by work certified. Any of the four formulae can be applied. The most commonly used is the second formula. Estimated profit into cash received by work certified into work certified by contract price will be the most applied formula. After that, we moved into escalation clause. Escalation clause is a revision in contract price subject to increase in cost of materials and wages. The amount of escalation claim calculated must be added to both the contract price and also to work certified. With that, contract costing was over. Then we moved into process costing, where a product passes through multiple processes before it becomes finished goods. As part of process, normal loss is inevitable. That normal loss is subject to scrap realization. Normal loss is an estimated percentage on input. Actual input minus normal loss will give you expected output. Compare expected output with actual output. When the actual output is more than expected output, you call it abnormal gain. When the actual output is less than expected output, you call it abnormal loss. The cost per unit is calculated as the total of debit side minus scrap realization divided by estimated output. Once you get cost per unit, you can multiply with the units of abnormal gain or abnormal loss or the units of transfer to next process to get its value. So, with that, the preparation of process account in the basic step is over. Then we moved into statement of equivalent production sums, where we dealt with WIP. There are two ways of preparations of statement of equivalent production sums. One is FIFO method, the other is weighted average method. In case of FIFO method, opening WIP will be taken for processing first and then the newly introduced units will be taken for completion. The percentage of degree of completion to be taken. For opening WIP, it will be the remaining degree of completion. For the newly introduced units, it will be 100% complete. For normal loss, it is not subject to any processing. For abnormal loss or abnormal gain, it will be 100% or the percentage as given in the question. For closing WIP, you will take the given degree of completion. With that, you will get equivalent units for every element of cost like material, labor and overheads. Second step is cost per equivalent unit. While finding that, if there is a scrap realization, reduce it from material cost, divided by equivalent units, you will get cost per equivalent unit. Then you have labor and overheads. For there also you will have to find cost per equivalent unit. Third step will be valuation, where you will find the value of transfer to next process, closing WIP, abnormal loss or abnormal gain. The last step will be preparation of process account, where it has to balance. While preparing the statement of equivalent production, if it is an intermediate process, there may be two different materials. One is material 1 and the other is material 2. Material 1 is the raw material which is brought forward from the earlier process. Material 2 is the new raw material which is added into this process. If there are two different materials, material 1 is always 100% complete in all aspects. And for material 1, if there is a scrap realization, you will adjust it only from material 1 and not from material 2. Then after that, we moved into weighted average method for statement of equivalent production, where you will not take the opening WIP as first completed and then the newly introduced. You will not break it up then. You will take the entire completed units as 100%. Then, while finding the cost per equivalent unit, you will take the value of opening WIP plus the cost incurred for the period. You will know the total cost. Divided by equivalent units, you will get the weighted average cost per equivalent unit. In valuation step, you will find the value of transfer to next process, closing WIP, abnormal loss or abnormal gain, and finally the process account has to tally. How to identify that one particular sum is to be done on FIFO or weighted average method. If they give you the breakup of cost for elements under opening WIP and they have not given you the degree of completion of opening WIP, it is an indication that you can do it only using weighted average method. Then we moved on to joint product and byproduct. A product which is initially planned for production is what you call as joint product. A product which is incidental to the production process which was not pre-planned is what you call as byproduct. In this chapter, we studied allocation of joint cost among the joint products and byproducts, where we discussed reverse cost method, physical units method, net realizable value method, sale value and split off point. If it is reverse cost method, sales minus profit total cost minus post separation cost, you will automatically arrive at the share of joint cost. In case of physical units method, the amount of joint cost is shared in the ratio of units among the products. In case of sale value at split off point, the goods can be either sold at split off itself or after further processing. If it is sold at split off, you will find the sale value. In that ratio, you will allocate the joint cost. If it is on the basis of net realizable value method, sale value after further processing minus further processing cost will give you NRV, and in that ratio you will allocate the joint cost. In case if they are asking you a recommendation on whether the product should be further processed or sold at split off, you will compare the profit of product under both alternatives and you will recommend either to sell at split off or after further processing. With that chapter was over. Then we moved into the last concept in the methods of costing, which was operating costing, which is applicable to the service sector, where you add all the costs related to the particular operation. If it is hospital, it is on the basis of patients. If it is resorts, it is on the basis of room days. If it is a cinema hall, it is on the basis of number of shows. If it is a transport sector, it is on the basis of number of passengers and so on. Add all the costs, add the profit margin. The resultant value, you will not call it as selling price. There is nothing to sell here. You will call it as takings or revenue or collections. Okay, with that operating costing also was over, and with that the methods of costing itself was over. Then we moved into techniques of cost control. Techniques of cost control are three: marginal costing, standard costing, budgetary control. Under marginal costing, we consider only variable cost for decision making. While preparing the marginal cost statement, sales minus variable cost is contribution, minus fixed cost is profit. Any decision to be taken using marginal costing, contribution will be the influencing factor. For the various formulae we discussed, PV ratio is contribution by sales into 100. 1 minus PV ratio is variable cost ratio. Sales into PV ratio is contribution. Contribution by PV ratio is sales. Then change in profit by change in sales into 100 is also PV ratio. BEP in value is fixed cost by PV ratio. BEP in units is fixed cost by contribution per unit. Margin of safety is present sales minus break-even sales or profit by PV ratio. Sales to earn a desired amount of profit is fixed expense plus desired profit by PV ratio or fixed expense plus desired profit divided by contribution per unit. With these formulae, we applied various concepts. Then coming to the decision making, we discussed on limiting factor. When a particular resource is limited, you will first find contribution per unit, then you will find contribution per limiting factor, you will rank the products and prioritize production based on the rank. If raw material is the limiting factor, you will find contribution per kg of raw material. If labor hours is limiting factor, you will find contribution per labor hour. If machine hours is limiting factor, you will find contribution per machine hour. If sales in value is limiting factor, you will find PV ratio. If sales in units is limited, you will decide based on contribution per unit itself. Then we analyzed on the various sales mix combinations. Then we discussed on expansion of plant, we discussed on export order, we discussed on closure of a plant, and so on. Those are the key areas where marginal costing is applied for decision making. By assisting the management in decision making, they have a control over the organization. Then next we moved into standard costing. Standard costing is variance analysis, where you analyze the standard cost and actual cost. There you have only two variances, material variance and labor variance. Material variance is SPSQ minus APAQ, which gets divided into two. Material price variance, material usage variance. Material price variance is SP minus AP into AQ, usage variance is SP minus AQ into SP. Usage variance gets divided into mixed variance and yield variance. Mixed variance is RSQ minus AQ into SP. Usage variance only is SQ minus AQ into SP. That gets divided into mixed variance and yield variance. Mixed variance is RSQ minus AQ into SP. Yield variance is SQ minus RSQ into SP. To the right side, 1 minus 2, 1 minus 3, 1 minus 4. To the left, it is 3 minus 2, 4 minus 3. For the four columns, the second column is always actuals, which is APAQ. First column is SPSQ. Third column is AQSP. And the last column is RSQSP. Then we moved into labor variance, where the labor cost variance is SHSR minus AHAR. That gets divided into labor rate variance and labor efficiency variance. Labor rate variance is SR minus AR into AH. Labor efficiency variance is SH minus AH into SR. That efficiency variance gets divided into gang mix variance and yield variance. Gang mix variance is RSH minus AH into SR. Labor yield variance is SH minus RSH into SR. There also, to the right side, it is 1 minus 2, 1 minus 3, 1 minus 4. To the left, it is 3 minus 2, 4 minus 3. Second column is AHAR. Every other column, it is SR. First column is SHSR. Third column is AHSR. Last column is RSHSR. What is this SQ, SP, AQ, AP, RSQ, then SH, SR, AH, AR, RSH? SQ is standard quantity for actual production. SP is the standard price. AQ is actual quantity. AP is actual price. RSQ is the revised standard quantity, which is the actual quantity in standard mix. Given the output, if the output matches, if the output for standard quantity and actual quantity matches, you will take SQ as given itself. If the output does not match, you will have to find standard quantity for actual production and only then proceed. Likewise, SH is standard hours for actual production. AH is actual hours, SR is standard rate, AR is actual rate. Here again, if the output is given, compare the standard output with actual output. If they both match, you can take SH as it is. If it does not match, you will have to find standard hours for actual production and then proceed. You will have classification of the usage variance in material and the classification of efficiency variance in labor only if there are multiple materials for material variance and if you have multiple laborers in labor variance. Otherwise, your answer will end with material usage variance and labor efficiency variance respectively. After variance analysis, we moved into budgetary control, where under budgetary control, we prepared production budget, purchase budget, expenditure budget, where we call it as a flexible budget and cash budget. Coming to purchase budget, it is for the purchase of raw materials. It is the consumption of raw materials plus closing stock of raw materials minus opening stock of raw materials, which will give you the purchase quantity. When it comes to production budget, it is the sale of finished goods plus closing stock of finished goods minus opening stock of finished goods, which will give you the production quantity. Coming to expenditure budget, you will classify the cost into variable, fixed, and semi-variable. Variable cost will change with change in operating capacity. Fixed cost will remain constant. Semi-variable cost, they will give you how much is variable and how much is fixed. Based on the proportion, the variable cost will change with change in capacity. Fixed cost will remain constant at all levels. The total of all costs will give you the total expenditure at various operating levels. That is flexible budget. When it comes to cash budget, you start with opening balance of cash, add whatever is received, subtract all the payments, you will get the closing balance. The closing balance of one period becomes the opening balance of the next period. While adding and subtracting, you will not make a classification between capital and revenue expenditure or capital and revenue items. You will add whatever is received, you will subtract whatever is paid. You will not make a distinction of capital and revenue items. As regards the outstanding expenses, if they say as a fraction, if they say 1/4 is wages outstanding, it means 3/4 is paid in the same month and only 1/4 is outstanding. Whatever is the fraction given, only that fraction will be outstanding. The remaining fraction will be considered as paid in the same month itself. Then, after cash budget, we summarized on budgetary control. Then we moved into the last topic, which is cost bookkeeping. There are three segments of cost bookkeeping: cost sheet, reconciliation statement, and integrated accounts. In cost sheet, you have simple cost sheet and comprehensive cost sheet. Simple cost sheet is direct material, direct wages, direct expenses, prime cost, plus factory overheads, works cost, plus administration overheads, cost of production, plus selling overheads, cost of sales, plus profit, sales. In case of a comprehensive cost sheet, opening stock of raw materials, plus purchases, minus purchase returns, plus freight, minus closing stock of raw material will give you raw material consumed, plus direct wages, plus direct expenses, prime cost, plus factory overheads, gross works cost, plus opening stock of WIP minus closing stock of WIP, net works cost, plus administration overheads, cost of production, plus opening stock of finished goods minus closing stock of finished goods, cost of goods sold, plus selling overheads, cost of sales, plus profit, sales. This is the format of cost sheet we have to follow. Then, with respect to labor efficiency, when a laborer is more efficient, he will be paid less basic wage because he completes the task earlier. So, when they have given you about efficiency percentage, it should be always 100 in the numerator. If it is a lesser efficiency, it will be a lesser number in the denominator. If it is a higher efficiency, it will be a higher number in the denominator. With that, the cost sheet chapter was over. Then, coming to integrated accounting, where there are two sets of accounting system which is followed. One is integrated accounting and the other is non-integrated accounting. In case of non-integrated accounting, the costing books are maintained separately and financial books are maintained separately. That is why you need to reconcile the costing profits and financial profits. In case of integrated accounting, you have a scheme of journal entries where you will take the debit from cost accounts and credit from financial accounts. This rule of debit from costing and credit from financial will not apply in case of return entry and sale entry alone. Every other entry, you will take the debit from costing and credit from financial. In case of entries in cost accounting books, you will, instead of referring it as cash, debtors, creditors, or instead of using the financial terms, you will use general ledger adjustment account or cost ledger control account. Any entry in cost accounts will have a suffix of control account, material control account, wages control account, overhead control account. So, costing P&L account. So, these will be the entries which is posted in costing books. After doing it in a separate basis, separate method like non-integrated accounting, you will end up in reconciling. While reconciling, you will start with profit as per financial books, end with profit as per cost books, or start with profit as per cost books and end with financial books. For every transaction, you have to analyze whether it is inclusions or exclusions. You will have to add and subtract accordingly. If it is the profit which you are starting with profit as per financial accounts, you have to look into the adjustments to be made to financial accounts to arrive at profit as per cost accounts. If you are starting with profit as per cost accounts, you should look into the adjustments to be made to cost accounts to arrive at profit as per financial accounts. With this, I am signing off. Thank you all.